Hello, traders. Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Today, we're going to take a deep look into what's driving the price action in the Russell 2000 and how traders and investors can use that information to help guide their decision making for the rest of 2022. My guests today are Mark Barnes, PhD, Head of Investment Research, Americas at FTSE Russell, and Russell Rhoads, Head of Research at EQDerivatives. Today's podcast is sponsored by FTSE Russell. Did you know that with an 81% share and 1.6 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors. CME Group has selected the Russell 2000 index for new event-based contracts launched on September 19th. The daily options on futures contracts will offer short-term trading opportunities for investors seeking to take a position on the Russell 2000 futures daily price moves. For more information on the Russell 2000, please go to FTSERussell.com. Mark, Russell, welcome to the show.
Thanks for having us.
Thanks for having me here.
Russell, you've been a repeat on the show. We've talked about the Russell every time. Every time we come on, we talk about your name.
I know. In fact, I worked at one entity a while back where we did an awful lot with FTSE Russell. And if we were talking about the FTSE Russell people, we would say the Rut people. And just not to get me confused with the entity. Although I don't know why that would have been confusing. But and needless to say, whenever you and I were talking about FIAs in Chicago in the near future, I'd come back to my desk filled with Russell swag because everybody just thought that was hilarious. So I got more FTSE Russell notebooks than I know what to do with.
Well, we've got my favorite person to talk about the Russell. Mark, this is the first time you and I are meeting, but we've talked a little bit in the past through emails. I've read your reports. I've watched your videos. You give amazing information on the Russell 2000. So thank you so much for joining me today.
Great to be here.
And one of the things that you did, Mark, was put together a presentation for us. And tell us what we're going to be looking at and hearing from you today in this presentation.
Right. Well, so we at FTSE Russell, we put out, well, we're not an investment advisor, right? So we don't give investment advice. We don't manage money. So what do? We have a ton of data related to our indices. And so we cover equities, we cover fixed income, we have commodity data, and we have a lot of other data, especially after the acquisition of Refinitiv last year. So one thing that we try to do to help investors is we try to pull all this data together, organize it, and put some commentary around it to try to help tie these different pieces together. We have reports on just general performance of different asset classes. We've got some on sustainable investment investing, fixed income, equity factor report. And then this Russell US Indexes Spotlight report is specifically on the US equity market using our Russell indices as sort of the building blocks. So we try to summarize what's happened in equity markets in the United States, not only sort of the overall market movements, but large versus small, value versus growth, and then think about what macro factors have driven the patterns that we've seen. We put this out on a quarterly basis. There's a little snapshot of it there on the screen. So what I'd like to do, I pulled a few slides from the presentation. And again, usually it's on a quarterly basis. I've updated it a little bit to include some October data. October is a really interesting month. So I think I'm just going to click through and kind of give you an idea of what kinds of information we have in the report and in the webinar, and then be interested in hearing you guys talk about it.
Yeah, great. And I should tell everybody this Russell US Indexes Spotlight is available on FTSERussell.com. And it's one of those things where I always tell traders, when you're trading an index, you've got to know what's inside the index, what's happening inside the index. Russell, you and I talk about this all the time on this show, and we always say, know what's driving the index. And today, what I'm excited about with Mark is that he's going to tell us some of the things that are driving the Russell 2000, and I'm sure we're going to talk about that Russell 1000 as well. And the one unique thing about the Russell is that it's way more sector driven than when we look at the S&P and when we look at the NASDAQ. They could be individually name driven. Just look at what Apple did the other day, right? Or what these earnings come out. The Russell is not necessarily like that. Wouldn't you agree, Russell?
Oh, absolutely. And it's, I mean, just by the number of names that are in the large cap Russell 1000 and the small cap Russell 2000. But beyond that, and I know we're going to see in a second what industries have driven some pretty decent October performance. You pay close attention to the different industry weightings in the large cap index versus the small cap index, because even though they're both great broad-based indices that give us an idea of how certain stocks or certain types of stocks are behaving in the U.S., if we looked at them as single companies, the Russell 1000 and the Russell 2000 have a lot of differences. If you just think of it as one big conglomerate, and you'll often, you'll see people on the business networks talking about, well, the Russell 2000 was quite the outperformer over the last couple of days. Well, that's typically because the industry overweightings in the Russell 2000 versus the Russell 1000. It's definitely a unique index, and why I've always liked to trade it.
Yeah, definitely. All right, Mark, let's go through it.
Okay. So I like to start off with sort of just an overview of what happened to the markets, and we'll put the recent performance in the context of a longer performance. So we have a time series chart here showing 1 year of performance. Now, the time series I think is actually important. A lot of times we look at like quarterly numbers, and you lose kind of what happened during the quarter. And so the two vertical bars there show, delineate sort of Q3. At the beginning of Q3, you had a rally, sort of an optimism rally, perhaps. It seems like it was the bad news is good news kind of story, where things were so bad that a lot of investors thought that the Fed would need to cut back on their tightening cycle, and that would be good for stocks. So markets were up. And then at Jackson Hole, where the Fed kind of popped that bubble and said, no, we really are going to focus on inflation, and markets sold off. So my point there is market went up, market came down. Overall, Q3 was kind of a quiet quarter if you just look at the overall numbers, but there was a lot of action going on, and understanding that action, I think, is important for understanding how markets respond to sort of the macro effects. Now, that chart specifically in the black line is the Russell 1000 larger cap and the Russell 2000 in the blue. Another thing about the Russell series that is convenient, I think, is by splitting up into not only the Russell 1 and the Russell 2, so large cap versus small cap, but also we have value and growth variants of those indices. And so we can really kind of do some slicing and dicing and understand what happened. Now, the bar charts on the right show, I've squeezed in the October performance as well as the Q3 and year to date. From the year to date, you can see that things have been really bad. I mean, we're all kind of aware of this, but some patterns also start to emerge. Over the entire period, you can see that at the very beginning, Russell 1 outperformed. So basically, there was a big sell-off of small caps. But since then, small cap stocks have really been grinding back. And if you look at the year-to-date numbers, finally, it's the case that the Russell 1 numbers are worse than the Russell 2 numbers. So that they finally kind of come back. And then another thing is that value was doing relatively well because growth sold off so much. There was a reversal of that in Q3 when you had that optimism rally. But interesting, very interesting, I think, is that in the October rally, value once again outperformed. And so you just have all of these dynamics, and it's really interesting to kind of think about what is driving that performance during the quarter.
Yeah, no, it is. And I always like looking at the difference between the Russell 1 and the Russell 2 because it helps you as an investor, not only in the Russell, but understanding what's happening in the overall U.S. economy.
Yeah, I don't pay as close attention, and now I just noted that I need to pay more attention to the growth and value breakout. So the 1000 and the 2000. If you had asked me to guess and tried to make me look a little silly in front of people, whether growth or value outperformed for the 2000 and the 1000 in October, I totally would have guessed growth outperforming value. I always want to comment when I see something that that kind of startles me, and those final little bars over there with the Russell 1000 value up 10.3% and the Russell 2000 value up 12.6%. versus growth underperforming pretty substantially. That's a big surprise to me.
Yeah, for me on a personal level, the only time I really recognize those things is when Mark points them out to me in the spotlight. That's how
So, and just another comment along those lines is I've been, and you hate to have too much of a preconception or get anchored to what you think with respect to the markets, but I feel like the worst is behind us in the equity markets. But if the worst were behind us in the equity markets, I would actually expect growth to be outperforming value. So that's making me question my belief, which, everybody should do all the time. Don't get anchored to anything.
Yep. All right, Mark, let's see what's next here.
All right. So this is just sort of another another view of this slicing and dicing. So these are relative performance charts. And this just is to highlight, again, these dimensions. So the first one shows the Russell 1 versus the Russell 2. So if that line is going up, it means the Russell 1 is outperforming. And what you can see there is, this does include Q4 of last year, but even if you it's hard to tell, beginning of this year, Russell 1 relatively was off to a good start. Now we know markets were down, so what that means is that the Russell 2 was down more than the Russell 1. Since then, it's been up and down, but kind of a grind back, and to the point where small caps have actually outperformed large caps year to date. So that is kind of a surprise. Now moving to the chart on the right, again, relative performance chart. So this is the growth versus value for both Russell 1 and Russell 2. And the fact that this is dropping over the period means that value has been outperforming growth. And we've seen that. Now, what's interesting is toward the end, so if you take the spot, right past April 22nd, although the dates are hard to understand, that's when you get the optimism rally. And it is the case that growth was outperforming value during that optimism rally. When you started to see the sell-off again, value started outperforming growth. Now, the interesting thing, as Russell just said, is that has continued into the October rally. In the October rally, you continue to see value outperforming growth, despite the fact that markets were up strong. And I think that's what really jumps out at me.
Yeah, I think for traders and investors, you got to really keep an eye on that, because that's something that could easily be taking place, and then you look for leadership.
And just I'm looking at the chart on the left, even though you talked about the one on the right a little bit. Historically, the Russell 2000 outperforms the Russell 1000 in the fourth quarter more often than not. That's the best pretty much the best 3 months for the Russell 2000 or the last quarter of the year, which is, I think, surprising to a lot of people when you cite history. But that it looked like that trend was in place starting in October. Wouldn't be the least bit surprised if it follows through the end of the year as well.
So that gives an overview of kind of how markets perform. Then we kind of take a step back and think about what fundamentally in the economy is going on that's driving some of these moves in the equity market. And we know that inflation has been a big story, so we actually start with commodity prices. It could change, but recently we've been looking at commodity prices. This shows commodity prices, the chart on the left, over the last 12 months. And we're all kind of familiar that they really kind of ran up. Most of them ran up at the beginning of the year and really spiked with the Russian invasion of Ukraine. You can see that's that sharp spike early in the year. Now, one that didn't was copper. And I a lot of times think of copper as being sort of a proxy for economic expectations. It's sort of an industrial use commodity. And that has been weak throughout. I think that's kind of informative. Now, the other two commodities there, oil, we're kind of familiar with that. That was obviously affected by the Russian invasion of Ukraine and the sanctions that were put on Russia after that. That's not particularly a surprise. And then I threw wheat in here, which is another interesting one, because Ukraine produces a lot of wheat, and grains more generally, I think, are really important and have been affected by that. Now, there's been story that they were going to stop the shipment of grain out of Ukraine, and now they're going to restart it. So that may help. But you can see that wheat prices, the dark blue line, dropped and then have started to go back up. Now, I'm not an expert. Perhaps it's because we're getting closer to winter. People realize the Ukraine war continues, but those prices have gone up. And the light gray line there is actually a commodity price index. And you can see that again, went up, came down a bit, but it's been flat and quite elevated. Now, when we think about how that funnels through into the economy, we think about inflation expectations, which we showed on the right. So the break-even inflation is just the difference between the nominal yield and the inflation linked yield for that bucket. So we have 1 to 3, that's sort of the medium term, and then we have a 7 to 10 year. You can see that the long term, the 7 to 10 year, really hasn't moved very much. So people do think that this is, I'm not going to get into the transitory thing, but they do think it is something that is going to work out eventually. You see the big spike in the 1 to 3 year, and it started to drop as the Fed became much more aggressive in thinking and talking about how they were going to rein in inflation, and that has come down and dropped quite a bit to the point of touching the long-term break-evens, until at the very end of the period it has started to creep back up again. And I think that's something that we need to keep an eye on.
The copper one is somewhat of a surprise, but if you start thinking about global economic activity and where copper would be consumed, there are markets that are still being, the labor is still being negatively impacted by labor. And so I can see lower demand for, I can just see lower demand for copper, not being indicative of what's going on in the United States, but being indicative of what's going on over in Asia. The oil price, I'm absolutely shocked that it's not well over 100. I know on this chart everything's indexed to 100, but the price of oil continues to perplex me. Anthony, I think all three of us have been around long enough that we can recall there used to be a geopolitical premium to the price of oil, and I think after the Iraq War it went away for a decade or so. I don't think waking up and having Iran and Saudi Arabia shooting at each other is discounted in the oil price at all. And I do think that there are some things that might spark up in that part of the world that could push oil back up very, very quickly. But it's just interesting to see it at such a low price. I know we're going to get into stocks and how energy stocks have performed so well. They've definitely been a beneficiary of higher oil prices. Maybe they're toying around a bit so that at the same time that they're reporting these record earnings, which is not politically favorable to them, they can at least point to oil being down in the 80s right now. Be interesting to see what happens when earnings season is passed for all of those companies.
Yeah, I think what's interesting to me about the commodities this year is that you have such a strong dollar. Mm-hmm. And then you've got all of these headlines, right? And you've got that are driving commodity prices. We talk about Ukraine war and other things, but you have the super strong dollar, which really would be, is working counter against some of the headlines, right? So you could see the story and it makes a lot of sense. I go back to oil and I'm just wondering if maybe just because the dollar is so strong, and we know that the U.S. government has done some things by releasing more barrels. And I know that even though maybe in the big picture, it's not that big of a deal what they're adding to it, but I think that psychologically that with a dollar, you just got this fight, and it's just one of those things where I agree with you though, Russell, at some point, another headline, boom. And I think that changes. It doesn't matter what the dollar's doing. It'll be all about supply and demand really fast. But it's why commodities are so tough. It's why I stick to stocks. like those are so much easier. All right, yeah. Mark, let's take a look at the next slide we got here.
Okay. All right. Well, thinking about how those inflation expectations kind of feed into the economy through monetary policy, here we look at interest rates. So the chart on the left has U.S. government bond yields. So the 2-year is the black line, the 10-year is the light blue line. Those are going up. And we know that interest rates have gone up, and we're familiar with the fact that long rates have gone up as well. Now, the fact that those have crossed, you can see, means that the yield curve is inverted, and you can see that because the dark blue line at the bottom, which is the spread, the 10-2-year spread, has gone negative. Now, a lot of people think that is a sign that there's definitely going to be a recession. I think jury may be out on that, but it's definitely showing the weakening expectations of economic growth when you start to see an inversion like that. The chart on the right is just a little bit redundant, but basically it looks at the yield curve at different points in time, the bottom being the beginning of the year, and then you can see that at the end of the various periods, that yield curve has gone up, marched up as the Fed has tightened, but also significantly you see the inversion as the long end hasn't gone up as much. So this just gives us an idea of the yield and interest rate environment that is affecting equity markets.
This is the one thing I think that's puzzling a lot of people, right? Is that, are we in a recession? Are we not? I know we were going back and redefining it at some point this year, but I've read and looked at so many different people that will say to you that we're just not, there's so many things that are telling you, jobs and other things, and I'm not a macro expert by any stretch, but that we're not in a recession. But I was brought up that and I was taught this, that if you see what I'm seeing on this chart, that we're going to have a recession. I don't know what you think, Russell.
Back in the day, I used to, the way that, and I know it sounds like I'm not answering your question at all, but I swear I am. Back in the day, nobody believed the economic numbers coming out of China. And the way that you could keep up with what was really going on in China was Yum Brands. About half the company was over there, and you could look at their revenues every quarter and see if they were going up or going down. I think Amazon in the US is the same thing. And Amazon just had a terrible quarter.
Yeah.
And it really is a discretionary. I've got 2 teenagers and my wife in the house, and there's always 1 or 2 things in the Amazon box. There wasn't today when I had to go order something, but there wasn't today and I've noticed there are fewer boxes showing up and I consider us somewhat of a typical consumer. We've been cutting back just a little bit. Part of it's because I got kids getting ready to go to college, but I do and I've got a relative that works for Amazon. They've been going around the floor still and sending people home because they don't have enough to do in the distribution centers. So the point there is the third quarter, they had and it hasn't gotten any better for them in October. So I think and Amazon sells a lot of stuff to a lot of people. I think we're in a recession because of just what I've heard out of Amazon and what apparently is going on in the fourth quarter.
Yeah, I was going to be interested to see if it finally gets announced that we are in one or not. But this is a very interesting chart and something that all investors need to keep an eye on. Thank you for the slide, Mark. Let's see what you have here next.
Well, you guys have mentioned this, but one of the side effects of the really aggressive rate tightening that the Fed has done in the United States, and I would say they tend to be ahead of some of the other countries as far as that goes, is just the strength of U.S. dollar. Now, we know that can be for different reasons. It's also the U.S. dollar is sort of a safe haven currency in some respects. But I think a lot of this is driven by aggressive tightening. So the chart on the left just shows the year-to-date currency movements against the USD. And what's really astounding to me is how big some of these moves are for currencies you wouldn't really think of as being susceptible to this. But and then interestingly, 2 of the countries we have listed here that actually appreciated against the dollar are the Brazilian real and the Mexican peso, are both sort of commodity exporters and may have benefited from some of the turmoil going on in Europe. It's also the case that Brazil, for example, had inflationary pressure last year, and so they had already started hiking. They were early in the hiking process, and they may have offset some of the damage there. But anyway, the fact that the U.S. dollar is so strong does have an impact. Now, you guys know all about the commodity stuff, but as far as equities go, one thing that's important for Russell is that global companies, the bigger companies, tend to have more exposure to foreign earnings. When those are converted back into U.S. dollar, that means a strong U.S. dollar that shrinks those earnings. And so this is going to hurt larger global companies more than it hurts smaller domestic companies. And in fact, I think the revenue from international earnings for the large cap Russell 1000 is about 40%. It's about less than half that for the Russell 2000 smaller cap companies. Now, the chart on the right just shows what damage has been done globally to equity markets with the interest rate hiking environment that we've had. Now, notice these are in local currencies, so this is not converting back to the US dollar. This is what those people on the ground are seeing. And you can see that the US indices listed here are toward the bottom. Emerging market actually is worse off. That's actually because of October, there was a big rally in the US, whereas the EM didn't see that. But just the damage that's being done to equity markets, I think, is going to have an impact on the global economy, and so you would expect to see some fallout from that. Interestingly, the UK and Japan are two countries that have not seen much damage to their equity markets with everything that's been going on.
I know we're speaking with FTSE Russell right now, but I'm going to utter the word Standard & Poor's. What Mark just mentioned with respect to the Russell 1000, about 40% of the revenue is coming from outside of the U.S. And about 20% for the Russell 2000. It's over half for the S&P 500. So that's even, that's another, another small cap's going to outperform large cap over the next few months right there. But yeah, for the S&P 500, it's over half, which when I was talking about, they're two very different companies. If you consolidate all the large caps and all the small caps, that international revenues is probably number one on the big difference between the two. As far as the currency that I'm a little surprised that's down as much as it is the Australian dollar, because they do, it's very commodity oriented, and usually the Canadian dollar and the Australian dollar are pretty much in line with each other. They're two of the most similar economies to each other that we have out there. The difference is Australia is more dependent on China than Canada is. And this kind of loops back to my thinking that the weakness over in China is bleeding over into a lot of other markets, and probably has some of the impact. I'm saying probably. I was in Australia in August talking to people about this. It has had more of an impact on the Australian dollar than the Canadian dollar or other commodity related currencies.
Yeah, one thing that I look at towards the end of this year when I see this and I look what's happening with the Russell 1 and the Russell 2 is that I do think from a technical standpoint, I think that the Russell 2000 will outperform the NASDAQ and the S&P towards the end of this year. When you just look historically too, when you have a weak tech like the way it is, it just doesn't just bounce back the same way. You talk about these things that are happening inside the S&P. The Russell doesn't have that same issues, right? And we go back to whether we're in a recession, and a lot of people will tell you that the U.S. is in a really strong place. So once again, that would lead to, if you're going to put your money somewhere as an investor and you want to buy some equities, I like the Russell more now than I do those other two indexes. And nobody talks about the Dow anymore, though, do they? I mean, does anybody? I only see.
No, that's yeah. You didn't mention when you introduced me, but I teach at Kelly at Indiana as well. And one of the first things that I try to get across to undergrads is the stock market is not the Dow Jones Industrial Average. I don't care what's on the national news every night. It's the S&P 500.
Yeah. I always look at the big three now as S&P, Russell, and NASDAQ, because that gives me a much better gauge of what's actually happening. So,
absolutely. All right. So now getting back to the equity markets and digging down a little bit more and looking at the industry, sort of the industry weights and then the performance. So in FTSE Russell speak, industry is our top level sort of industrial classification, and there are 11 of them. And starting on the left, that shows the industry weight for the large cap Russell 1 and smaller cap Russell 2. And the thing that does jump out is the big difference in technology weight. So the Russell 1 is loaded up on technology. That's down. I believe it was, if I recall, it was up around 30% at the beginning of the year. And just a lot of concentration in the Russell 1000. And we're kind of familiar with the narrative there, how well that industry has done over the last few years until the beginning of this year and the sell-off starting there. Now, the other two charts show just the returns within those industries. And I'll swing all the way over to the right, which is the year-to-date returns. And you can see a very distinct pattern, which is that everything sold off except for the energy industry. And it did really well. I mean, look at the the size of these numbers. These are very large numbers that we're seeing. So huge dispersion between energy and particularly technology and consumer discretionary. So the cyclical industries that did a lot of the damage in the sell-off early in the year. Now, interestingly, in October, which I've kind of wedged in there in the middle, all of these industries were positive. So the October rally really was very broad-based. It's hard to pin it on exactly, one particular group of stocks. It was quite broad-based. I think that's just indicative of sort of the nature of the rally and sort of the optimism that we saw in October.
Energy's where it's at, Russell. I mean,
Yeah,
that's where the action has been all year.
And just another, it's not a performance thing, but if you look at the industry weights on the 1,000 versus the 2,000 for energy, I think we all think of energy and we think of ExxonMobil, et cetera. We think of, those 4 or 5 behemoths, but there are a lot of smaller companies in the US involved in the energy sector, enough that it's a bigger weighting for the Russell 2000 than the Russell 1000. So another check mark for small cap if you think energy is going to continue to perform well. Also, and again, you hate to talk about the politics too much, but if there is a change in the balance of power in DC, you would assume that the smaller energy companies in the US that have to deal with some of the regulations that get thrown at them sometimes, if those get loosened up a bit, that's going to be very good for small cap energy stocks. It'll be good for large cap energy stocks as well. The discretionary part is covered up on consumer discretionary, but it's really interesting to see that the smaller cap consumer discretionary stocks performed as well as they did in October. Those are the October numbers, not the quarter numbers. Maybe people are feeling a little bit better about buying some high ticket items, or buying things that they don't feel like they have to put off as well. And I honestly, I could spend 20 minutes going through all of these, but I know we're time constrained here. So
yeah, the energy thing sticks out to me because when something's doing good in a year like this year, it tends to end the year doing really good too, right? Yeah. Just like when things are doing bad, they end up the year really just doing equally as bad as they have been or worse. A lot of times these years don't turn around, and I don't see any major shifts besides the election, which I think will have some impact. And that's why I don't like fading moves like this. And I like seeing graphics like this and understanding as a trader, as an investor, what's moving within these indexes and why potentially this would be something that to help me with the executing my trades for the rest of the year. Because if some of these things do take place, you can see how it's going to come in and impact the index. So really, really great slide here, Mark. Thank you. Let's see what we're looking at here now.
So this is similar charts, but you may notice there are twice as many bars. So basically this is looking at the value and growth, slicing and dicing of these things. Again, starting with the weights on the left, I'll just point out that technology is massive in Russell 1000 growth. So large cap growth, that number was up about 50% at the beginning of the year, and with the sell-off, it's gone down. But it is not, it is not very much a small cap growth. It is really concentrated in large cap growth. Now, moving back across to the year to date on the right, again, you can see that the energy performance was very broad based across all of these subdivisions for the year to date, and pretty much everything else, with a few exceptions, was down. Now, finishing with October in the middle, it's kind of interesting. If you put, so there are 4 indices here. If you add the 2 from the previous slide, so 6 indices we're looking at, 11 sectors, so 66 total industry subgroups. In October, 64 of those 66 were positive. So they, it's just showing again how broad-based that rally was. What's interesting is I went back and I looked at what happened in September when there was the sell-off. Every single one of the 66 was negative. Okay, and this just shows kind of the the big turn, the whiplash that we've been through from going from September to October. If you counted up things, you would see that value did outperform growth in 16 of these 22 for October. And again, this is just part of the fact that October was kind of a strange month because there was a rally, markets were up, and yet you had small cap outperforming large, and you had value outperforming growth.
And I think we continue to see that based on all the evidence we see into the end of the year. Even if we start to get weaker across the board, they'll be less weak is most likely the way I look at it as well.
And I find it, I know this is probably, I'm sure I'm missing something when I say this, but so what? Utilities, the way that they've held up this year, with as much as we hear about their input prices, you would think that utilities might be under a little bit more pressure than they have been. I mean, I know they're defensive stocks, but their input costs have to be going up with higher energy costs, and just the fact that they haven't, that they year to date, basically with one exception there, the Russell 2000 growth, they appear to be pretty close to flat for the year. I would have guessed worse just from what you hear in the popular press about energy prices.
Yeah, that's an interesting comment because a lot of people will park money in the utilities, like you said, for defensive stocks, just thinking that they may not do much. But with the things that you just talked about, that may not be the case.
Yeah, and everybody's looking for yield. That's the other side argument on that one as well. Yeah. Utilities will give you that.
All right, so just to finish up, so that's, again, we did sort of the overall market movement, some macro stuff, looking at industries, and just to finish up, more of a forward-looking view by looking at analysts' estimates. So the chart on the left shows revision ratio. So this is the ups minus downs over the ups plus downs. So if that number is positive, it means analysts are revising upward. If it's negative, they're revising downward. And we can see that earlier in the year that went below zero. Now, remember that if you go back to COVID, where you had that huge drop off, these dates are a little bit confusing. Then you have this huge, jump up as analysts are, after that, they're revising their numbers up, and that stayed with us for 2 years, let's say, or a year and a half, close to 2 years, and then you saw this steadily decline. Now, the most recently you saw a big drop in this. Particularly interesting is that for the Russell 1000, that has dropped very low very recently. Now, these numbers are a little bit volatile. We'll have to keep an eye on it, but it is interesting to see that they continue to go down, and there's been a big step down right at the very end. Now, on the right, we show the 12-month forward PEs, and this is how much market is paying for earnings in 12 months is the general idea. So when the market is selling off, we expect this to go down. But if you ever see a huge jump in this thing when markets are going down, that means that your earnings expectations have just collapsed, right? And we haven't seen that. And in fact, very recently, the P's went up a little bit when we had that rally. So we still haven't seen a collapse that you got earlier with the COVID collapse, where you see that huge spike in the Russell 2000 forward PEs. You get sort of a dislocation between prices and forward earnings. But with the view of the downward earnings revisions on the left, again, we're going to have to keep an eye on this and see what analysts think going forward. So that's the end of my presentation. I'll let you guys talk about this, but that's where I stop.
Sure. No, I mean, any final thoughts on what you have seen so far today, Russell?
Well, just go back one real quick. I want to talk about that. Sorry, now I'm taking over as director as well. I just noticed that the 1000 PE is really close to the COVID low as well, and you get as I mentioned, I teach at university, and I mostly teach graduate classes, so I get a lot of adult questions at the end of class because I open it up to anything you want to talk about. And one of the questions is, why are stocks not making new lows when we're seeing that 2023 is going to be an exceptionally difficult year? And my response is, a lot of the difficulty is already being discounted, that it's in the stock prices, and that might, that final chart there on the right that I made you pull back up, I think that's a good indication that is bad news is pretty much discounted by the market. Now, if it gets worse, we could definitely see earnings revisions lower, and the stock market go lower and the PE stay the same. But we just came off of what, at least rhetoric-wise, sounded like a very difficult third quarter earnings season. And we've got some revisions lower, but the stock market has held in there fairly well. So barring a really nasty recession in 2023, it's very difficult to be overly bearish in stocks, unless that's your belief.
Yeah, because expectations are changing.
Yeah.
Right.
Yeah.
And I always say it's not a news or headline that it will end a bear market. it'll be price, right? It'll be reactions to the news that we see.
Yep.
And as of right now, the Fed is probably going to stay doing what they're doing. As we know, like March of 23, we know that's really that cutoff time where we'll see what happens from there. But I think the rest of this year, it's hard to see them laying off of what they're going to do in December at the meeting. It's hard to see anybody setting higher expectations. So I think what happens is that the sell-offs possibly start to diminish a little bit, right? People aren't just really over anxious into selling into a 20+% down in S&P, 30+% in NASDAQ. And I don't know exactly how much the Russell was down this year, but I don't think people are in a big hurry there because of everything we've been through. But we'll see, right? It's just going to come down. There's so many different factors. A lot of what I take away today is you really got to keep an eye on the dollar. You have to keep an eye on what's happening in commodities, because if that dollar keeps going up, it changes so many things, right? So the dollar to me will be something that we really all have to keep an eye on as traders and investors for the remainder of the year and going forward, of course. If you're listening to this on audio or if you're on YouTube, there will be a link to anthonycrudele.com that will take you directly there to download that Russell Spotlight. And I think it's extremely important if you're a trader of indexes to take a look at that. But go to FTSERussell.com to learn more. And Mark, maybe specifically some places where they could go on FTSE Russell to see more of what you're doing.
Yeah, so FTSERussell.com, you can start there. There's a link you can click on research, and it leads you to a bunch of research papers and so on. Our reports currently are kind of mixed in there, but you can find our reports. And again, like I said, this is just the Russell. We also have multi-asset, more global. We have fixed income and some other things. So check those out. There's also a blog section where if we find something in particular we think is particularly interesting from one of these reports, we'll usually throw up a blog just to draw attention to what we think is interesting. So I think those are the best resources.
Well, thank you so much also for your presentation today, Mark. I know I learned a ton, and I always learn something from Russell. And so it's important to always stay in tune with what Mark's doing, what Russell's doing, because we need to know as traders, know what's happening within the indexes will help you become a better trader of the indexes. Russell and Mark, thank you so much, both of you, for joining me. And I look forward to more conversations with you guys in the future.
You bet. Thanks for having me.
Thanks.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.